Hello Accounting 101 students. In this video, we are going to go over notes receivable transactions and recording the interest associated with notes receivable. So we're going to start off with question number 5 in our chapter 8 end of chapter exercises. In this first problem, we have some transactions relating to notes receivable during the last 2 months of the year. And this company does not make entries to accrue interest except at year end. So we're going to go ahead and include the dates for all 4 transactions. And we know at the end of the year, we're going to be recording the interest for all of the notes receivable. So in the first part of this, on November 1st, the company loaned $61,200 in cash to CBOR on a 12-month 5% note. So later on, when we receive that interest, we know that we're going to receive a 5% interest on the amount that we loaned out. So our journal entry will be a debit to our notes receivable, which is our asset account, and a credit to cash for the amount that we loaned out. In this example, it is $61,200 in both the debit and credit columns. On December 11th, the company sold goods to CR Pine, receiving a $5,400 90-day 6% note. So because the company sold goods, they should be recording sales revenue as a credit in the amount of $5,400, and their debit for $5,400 will be to notes receivable. So in this case, instead of their customer paying cash or having an accounts receivable balance, they're going to pay them later within 90 days, and the company will be receiving interest because they're allowing their customer a longer time period to pay. Then on December 16th, the company received a $4,800 180-day 10% note to settle an open account from A. Murdoch. So in this scenario, they received a note, so we're going to debit notes receivable. And what it appears is that they have a customer that has an open account that is due. So their customer had a debit in accounts receivable, right? So they owed them money from this customer. But instead of the customer being able to pay that accounts receivable balance, they're saying, and let's transition this accounts receivable to a notes receivable. And the difference between the accounts receivable and the notes receivable is that the notes receivable typically has a longer time period for payment, and also there is interest that will be received. So the company is going to now credit accounts receivable, and the amount in our debit and credit columns is $4,800. Then we get to our last transaction on December 31st. The company is going to record the accrued interest revenue on all 3 of these notes receivables. So we're going to have to do a little bit of math here. And we know that when we receive interest, it's going to be an interest revenue. But because we haven't received it yet, this is going to be an interest receivable. Okay, so we're going to debit interest receivable and record our interest revenue because we have earned that revenue. Okay, so we haven't received it yet because it doesn't say that we've received it. We're only accruing for it. So we're going to do a little bit of math in order to determine the dollar amount. So we have this first note from C4, okay. And on this note, we're going to take the amount that is for the notes receivable, so $61,200. We're going to be multiplying this by the 5% interest rate on the note. So I'm going to multiply that by 0.05. And we're going to accrue the interest for the whole month of November, because we note that the date of the note is November 1st. So we need to do the whole month of November and the whole month of December, because we're recording this journal entry as of December 31st. So I'm going to multiply this by 2 over 12 months. So when I multiply this out, we have $510 for this first note. Then we have our second note from C.R. Pine. And this note was for the dollar amount of $5,400. We're going to multiply this by the interest rate on the note, which is 6%, so 0.06. And the time for this note, okay? So this note was issued on December 11th. So our interest is for the time period of December 11th through the 31st. So that's going to be for 20 days. And when you compute interest on a note, you're going to exclude the date that the note was issued, but include the date that you're computing your interest for. Okay, so if you start off with calculating just on your fingers, you can start off with December 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23, 24, 25, 26, 27, 28, 29, 30, 31. So you can see that this is for 20 days. So in our calculation, we're going to take 20 days divided by 360 days. So one of the things that is interesting with our interest on our notes receivable is that we compute interest for 360 days versus 365 days. We're assuming that the bank is not going to compute interest for 5 holidays. So the dollar amount you're going to have here for this note is going to be $18 when you input this into your calculator. Then we have our last note. This is going to be for A. Murdoch. And for this last note, we're going to take 4,800 times 10%, 0.01, times, and this note was issued on December 16th. So we're going to compute interest for the time period of December 16th through the 31st, which is going to be 15 days. So we're going to take 15 divided by 360, and we're going to come up with $20 for interest. So for the interest amount, you're going to add together the amount for our journal entry. We're going to add together 510 plus 18 plus 20. So the dollar amount is going to be $548 that we're going to include as our debit and our credit. All right. The next problem that we're going to go over fairly quickly is going to be question number 2. So we're going to go ahead and switch over to this question now. For this question, we have 3 promissory notes and we need to determine the maturity date. So the first thing that we're going to do is for the first note on April 1st, we're going to determine the maturity date, and the term is going to be 60 days. So we're going to compute interest for the period of April 2nd through the 30th. So that's going to be 29 days. We're also going to be computing interest for May 1st through the 31st. So that's going to be 31 days. And if you add that up together, that's how you're going to get to your 60 days. So our maturity date for the first example right here is going to be May 31st. In our second example on July 2nd, we're going to be computing our maturity date starting with July 2nd. So our time period for interest will be July 3rd through the 31st, which is going to be 29 days. And then on August 1st, we're going to need one more day to get to 30 days. So our maturity date is going to be on August 1st. So I'm going to go ahead and include August 1st. And our last example on March 7th, this note is going to be for 6 months. So because this is going to be for months, we're going to exclude the first month. So we're going to have the month of April, May, June, July, August, and September. That gives us 6 months. So the maturity date is going to be on September 7th. Now we're going to go ahead and compute the missing pieces for this part of the problem. So basically, to compute the interest, you're going to take the principal, which is the amount of the notes receivable in this example, times the annual interest rate, times the period of time in terms of days or months, and you're going to get to your interest amount. So in our first example, we're going to take our principal of $563,600 times 11%, and we're going to multiply this by the 60 days divided by 360 days, and we're going to get our total interest. And when you input this into your calculator, you're going to get 10,333 when we need to round to 0 decimal places. Then on July 2nd, we're going to take the amount of the loan, but we don't know the interest rate, so we're going to do a little bit of math here. So the amount of the loan times X interest rate, and we're going to go ahead and multiply that by our 330 divided by 360 time equals our 645. Okay, so it's 85,950 times X interest rate times 30 over 360 for our days equals 645. When I do the math here, I'm going to take 85,950 times 30 divided by 360. That's how I get 7,162.5 X equals 645. Then to solve for X, I'm going to take 645 divided by 7162.5, and that's going to equal 0.09. So that's how I'll get 9%. In our last example, I'm going to take 126,560, the principal, times the annual interest rate of 12%, times 6 months divided by 12 months, and that's how I'm going to get $7,594 to include in my problem. So please take some time to practice our journal entries as well as the interest calculation. Thank you.